Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. Shares of Teck Resources are higher in today's trading. Not that much, but they're up. British miner Anglo American has received approval from the Canadian government to acquire the Vancouver-based company. This clears the way for the creation of a $50 billion U.S. metals giant focused on copper mines in Chile and Peru. Both companies say they will seek inclusion in Canada's major stock indices and spend at least $4.5 billion in the country over the next 5 years. Shares of WSP Global are moving higher. The Montreal-based company has reached a deal to buy an American engineering firm from Warburg Pincus. WSP will pay $3.3 billion US for TRC companies. TRC sells engineering and consulting services to electrical utilities and energy firms. The acquisition would position WSP as the largest engineering and design firm in the U.S. Shares of the Ford Motor Company are edging higher today, about 0.3. Actually, they're off now a little bit. They were edging higher. A little bit of a downturn, but the markets are all struggling right now. The automaker boosted its 2025 outlook and says it will also shift focus from EVs to gas and hybrid. As part of a strategic plan, the company will take a write-down of $19.5 billion US in charges tied to the overhaul. The majority of them will come in the fourth quarter. And looking at the markets, they've been all over the place, but a lot of it in the red. The TSX right now, you can see off by 0.75 percentage point right now. And south of the border, not much different really. Everybody in the red, quite solidly in fact. The S&P 500, 0.77. The new employment numbers we're going to talk about in just a minute, but that's having a factor right now. You can see the Dow is off by 0.86. The Nasdaq down by 0.52. Yeah, those markets are reacting to the latest U.S. jobs data, which showed an uptick in jobs for the month. But there are some other parts to it as well. Let's get more from Steve Rolls, Senior Portfolio Manager at Trivest Wealth Counsel at Wellington Altus Private Counsel. And Steve, thanks very much for joining us.
Roger, great to be here.
Your thoughts on the initial numbers. What do you see that's good? What do you see that's a little more concerning?
Yeah, interesting day. My 25-plus career, I don't think I've ever seen a day when we've had so much data and important data. But looking at it collectively, it's somewhat of a no news day, and we're more focused on the employment numbers coming in January. It sort of saw two sides of the tail there. That in October they were down 64,000 and up in November, and so the market's just really looking at, okay, how does that apply to justification for the recent Fed cuts, and looking ahead at projections in the futures for Fed cuts for January, March, and April. No changes day over day, so it's really not a big change. And the market's down, over half a percent on the stock market, and yields are down a few basis points as well. So that's primarily focus on January non-farm payroll.
Is that what everybody's waiting for? What about some of the other numbers that have come out?
Yeah, some of the other numbers that's important. We saw the retail sales, which came in a little bit under expectations. We're expecting 0.1, came in at 0. So it's that argument that the consumer is not as strong as some thought, and mixed with the employment means that, well, perhaps there's a 25% chance of a rate cut in January, but let's get more information. We'll get more information later this week with CPI data, and continuing story will develop with the Fed. What are they going to cut more or not? But primarily what I'm looking at the Fed is, what is their quantitative easing program going to be? I think that's more important than the actual cutting of rates at this time.
And what would you like to see with that?
What I would like to see, or what I think I'm going to see, it's a different thing.
Two different things.
We've had I call it artificial capitalism in the U.S. with these quantitative easing programs since 2008, which was a one-time emergency measure brought on by Ben Bernanke, who was an expert on 1929 crash and with the Depression, and what would have stopped that was effectively what happened in 2008. Fed did a great job. But we've continued that philosophy for many, many years now. Now we're coming up to our second decade of it. And when the Treasury is issuing $1.9 trillion of treasuries, who's going to buy it? And when you look at the Federal Reserve balance sheet, they're the ones who are buying most of the treasuries. They've just announced they're going to buy another $45 billion a month. So, if they hold over $5 trillion of treasuries and China holds about $800 billion, well, talk about the independence of the Fed. They really are the ones who are helping out the Treasury the most with funding the U.S. economy right now.
Okay, I want to get on to a couple of other subjects right now. One of the key earnings out today was Lennar, 46% slip in profit in the third quarter.
Yeah, that was the last quarter, and so they report later, and I'm a little bit concerned about Lennar. It's the housing market altogether. We saw it last week with Toll Brothers. Housing is not strong in the U.S., and compressions are starting to compress a little bit, and the actual valuations are quite high too. But it's really the excess demand or excess supplies and little demand, and so that without a strong housing market, I'm concerned about the U.S. market altogether. And now they can take rates down again, but it's not like Canada and the U.S., because in Canada, you get a 5-year mortgage and lower rates help trigger some stimulation in the housing market. But in the U.S., you get a 30-year mortgage and they're not portable. So you're not going to be selling your home. So if you got a mortgage 5 years ago for just over 1% or 1 to 2%, why are you going to sell your house, move across the street, and get a new mortgage? 30-year rates about 6.3. So that's sort of the main issue that the U.S. is dealing with right now, is that the housing market is tied to the mortgage market. And I don't see that changing unless there's some drastic fiscal policy changes, which have been talked about, but nothing really proposed that would unlock the value for housing.
And what kind of an impact, what kind of an impact does that have elsewhere then?
It has an impact because of, in Canada, we're so focused on the mortgage market that the Bank of Canada has really been lowering rates to help that. In the U.S., it really hasn't made a big difference. And we're seeing the U.S. has lowered rates dramatically over the past year and a half here, but the U.S. 10-year is still at 4.15. And so it's not having that big of an impact. So I think that really, the market is going to be more focused, not so much on the Federal Reserve cutting rates. It's going to be more focused on the bond market and what the bond traders are going to be doing with bonds. So I think we're in for an interesting year.
Okay, I want to get, we're almost out of time, but I want to get into the three stock picture. You're looking at Verizon first off.
Yeah, Verizon is a big telecom. Everybody knows about it. It's got about a third market share. But it's got a really nice dividend of about 6.8%. And as you can see by the chart, it has come down a little, but I'm quite optimistic on it because they have a brand new CEO who is a real turnaround expert. He came from PayPal, where he generated 3 times revenue during his tenure there. Previously, he was at Virgin as well, and actually started his career at AT&T. So he knows the business. And he's really focused on cost cutting. He's already announced some layoffs and cost cutting efficiencies. But more importantly, he's really focused on the customer service, so a cultural change there. So I think when you look at a company like Verizon, yes, it hasn't done that well, but it's really, when you add in a 7% dividend, I think in this type of market with geopolitical issues and whatnot, I think it's a great total return stock. So it's not just about the price appreciation. Let's get that dividend as well.
Okay, Steve, sorry, we got to wrap it up there. We're tight for time, but the other two you'd like to tell us from BAE, but we'll have to wrap it up there. Thank you, as always, for joining us.
Appreciate it. Thanks for your time.
Cheers. Steve Rawls is a Senior Portfolio Manager at Trivest Wealth Counsel with Wellington Altus Private Counsel. Well, there have been recent hints of more floor crossings in Ottawa after Conservative MP Michael Mah joined the Liberals last week. We'll tell you what we know after this. There have been more recent hints of more floor crossings after Conservative MP Michael Maude joined the Liberals last week, putting Mark Carney's government just one seat shy of majority. CTV's senior political correspondent Mike Couture has more.
Outside Michael Maude's constituency office, a small but vocal protest demanded answers to why the Markham Unionville MP crossed the floor to the Liberals.
I feel very upset, and we fight for our future. We fight for democracy. We fight for our children.
In a statement last week, Maude said he made his decision after listening carefully to the people in his riding about the direction of the country. Sources tell CTV News the energy minister helped recruit the former Conservative. Asked if there are others ready to join the government, Hodgson would only say this.
Let's say I'm getting lots of inquiries.
Conservative Alberta MP Matt Genereux met with Prime Minister Carney in November before deciding to quit politics. That was just days after Nova Scotia MP Chris D'Entremont crossed the floor, citing Pierre Poilievre's leadership. Now, in an interview with CTV's chief political correspondent Vassy Kapelos, the Conservative leader denied he is a liability to his party.
I'm very troubled that they made that decision, but the people in their ridings voted for the Conservative agenda that I'm continually leading on in the House of Commons.
One more floor crossing would secure a majority government for the Liberals. While he wasn't able to rule out more defections, Poilievre called the move undemocratic.
If Mark Carney believes that he should have a majority to go ahead with the high-cost policies he's running on, then he should get that mandate from Canadians in an election, not through dirty backroom deals.
Even if another Conservative crosses the floor, Poilievre says he will remain at the helm of his party for his leadership review in January. Mike Couture, CTV News, Ottawa.
Coming up, WSP is strengthening its leading position in the power and energy sector with its latest acquisition of TRC. We'll get more from WSP's CEO after this. WSP Global has announced it will buy TRC companies in an all-cash deal worth $3.3 billion US. This comes as the company continues to push its position in the power and energy sector. For more on this, we were joined by WSP Global CEO Alexandra J. Leroux.
The acquisition of TRC combined with the acquisition of Power Engineer that we completed a bit more than 12 months ago will really cement our position as the undisputed leader in the transmission distribution space in the U.S.
And you also say that this is going to make you the biggest engineering and design firm by revenue in the U.S.?
Yeah, with this acquisition, 8,000 people and $1.2 billion U.S. in net revenue, we are now, by total revenue, we are now the largest firm in the U.S. in engineering and design. So quite pleased about our position now.
Sorry, Alexandre. So you're bigger than a Fluor or a Bechtel or a Jacob Engineering?
Well, we need to be careful not to add the gross revenue of the contractors. But if you really take the pure engineering firm, like the Jacobs and AECOM and others, indeed, our total net revenue exceeds those of the firms that I just mentioned.
You are selling some stock here, at least 850 million in shares. Is that in Canadian dollars or US? Can you clarify for me?
That's in Canadian dollar.
Right. Okay. But you basically, how will you finance the rest of the purchase price here?
It's just public bond and debt financing that was secured just prior to the transaction.
So obviously you're pretty excited here. I mean, the electrical build out in the United States is just stupendous in large measure because of the power needed for data centers.
Exactly. I mean, and we need to remember that data centers, despite the hype that and everything that we hear around data center, it's still to this day a small portion of all of the electricity consumption in the U.S. And in Canada, for that matter. So we really wanted to position our firm at the forefront of not only the energy transition that is taking place, but the energy addition that is also taking place. All the transmission line, the average age of the transmission line in the U.S. are about 30 to 40 years old. So they're all going to have to be replaced. Connecting new transmission lines to existing grids or new grids will also be a real opportunity for us. And similarly in Canada, I mean, the average age of the transmission line are quite old. So all of that will have to be replaced, but also new grids will have to be designed. So we're quite hopeful that we have entered in the last 24 months in a very high growth area for the company.
Do you find you're turning away business in the electrical area with such a big business, such a big build out?
There's a lot of work, and we expect that a lot of work will take place over the course of the next decade. If I look back at the TRC track record on organic growth over the last 4 or 5 years, CAGR of anything between 11 to 12% of organic growth. And similarly, a year ago, the acquisition that we completed in Power Engineer was a similar track record. So we're quite hopeful that this will go on for quite some time.
Did you ever think you'd see such excitement about electricity? I mean, for decades, there was really very little growth in electrical demand in the United States and Canada.
You are right in saying that, but as I just said, I just mentioned, Power Engineer, for instance, for the last decade, they've been growing at north of 10% just organically over the last decade. So I think maybe this wasn't discussed as much, but really the aging infrastructure that the U.S. is faced with is something that will need to be tackled. And I see this as a real opportunity for us to expand the scope of services that we can offer to the major IOUs in the United States.
Alexandra, Canada, lots of other countries, including Britain and Ireland, people are frustrated at how long big engineering projects take, partly because of bureaucracy and an endless process of public approvals and NIMBYism. Do you think times are changing, though, that it is possible to speed up these big developments?
Well, the proof is in the pudding. So I feel that now all of our governments are well-intended. They're well-intended to expedite the approval of large infrastructure projects in the U.S., but also in Canada. And we see it not just at the federal level, but also at the provincial level. So time will tell, but at least I have not seen that level of intention and the desire to speed up infrastructure projects or the approval of infrastructure projects in a long, long time. So I think that's all very positive.
Now, you yourself are a financial type. You joined WSP as CFO in when you became, in 2010, you came in, and then 2016, you were promoted to president and CEO. Do you find it difficult sometimes talking to engineers? Do they try to baffle you with their engineering jargon, whereas you're a financial guy?
Well, look, I always like to say that, I'm surrounded by people that are much smarter than I am. So, but at the end of the day, I feel that we're very complementary. I think I bring a lot of skill set to the table and to this firm. And I do feel also that our people are bringing incredible domain expertise to our clients. So I think it's been an incredible marriage for all of us. And it's an honor for me to lead this team.
And that was Andy talking with Alexandra J. Leroux, CEO of WSP Global. Ford Motor Company will take $19.5 billion U.S. in charges tied to a sweeping overhaul of its electric vehicle business. This after struggling for years to make it profitable. We'll hear from the CEO after the break. Stellantis says it has surpassed 1,000 new hires for the upcoming third shift at its Windsor assembly plant in Ontario. The automaker says nearly 240 additional hires will be transferring from its Brampton factory. You'll recall Stellantis announced in October that it would move production of a Jeep model from that factory to Illinois. The company expects to hire up to 1,500 workers for the additional shift in Windsor by the time it launches in early next year. The Nasdaq is looking for regulatory approval to extend trading hours on its stock venues to 23 hours a day during the work week. The firm asked the Securities and Exchange Commission for permission to add an additional trading session from 9 p.m. to 4 a.m. Eastern Time. This would be in addition to pre-market, regular, and post-market. Nasdaq is the second largest exchange in the U.S. Shares of BRP are trading lower after the Canadian recreational vehicle manufacturer named former Renault Group executive Denis Leveau as the company's next CEO. Leveau will take over the job in February, on the 1st to be exact, when José Boisjoli is expected to retire after 36 years. Leveau, who is also to become a board member, has held a wide range of roles within the Renault Group around the world. On the down day for the market, you can see the TSX off by nearly 3/4 of a point. And when you look south of the border, things aren't much better. Similar numbers, a little slump going on right now. Concerns over the employment numbers driving the market down in the States. There you go. All of them in the red right now in the U.S. S&P 500 off by 3/4, Dow off by nearly 0.9, and Nasdaq off by 0.5. Ford will take $19.5 billion U.S. in charges tied to a sweeping overhaul of its EV business after struggling for years to make it profitable. Speaking with Bloomberg TV, CEO Jim Farley said the overhaul is about moving toward more profitable vehicles. Take a listen.
You know, we saw hybrids really take off the last couple of years, like, last month we had a 30% increase in our hybrid sales. We're now number 3 in I think we're 80% hybrid market share in trucks. So we saw this happening. We also saw the more expensive EVs, really suffer in the market, and the more affordable EVs to do better. And then the last couple months, it really was remarkable. The EV market in the U.S. went from 12% in the industry to only 5%. And that really, in the end, was the big decider for us. But look, we're going to 50% electric. It's going to be hybrids and E-revs and electric. It won't be just pure electrics.
So, every good trader knows you got to cut your losses when you recognize there's an issue. You're doing that in this sense with the F-150 Lightning as we now know it, and the T3 project, the next generation truck that would have been built in Tennessee. But you're able to, I guess, salvage some assets, and as a result, you've raised your profitability forecast from $6 to $6.5 billion for this year in terms of EBIT to $7 billion. Where are you gaining an opportunity from this, Jim?
Well, great question. This year, in the short term, it's really our cost of our company. Our quality is getting better, and so our costs are much more competitive. In fact, the Novelis aluminum has cost us more like $2 billion, but we're still raising guidance. Look, for this announcement, Matt, it's really about moving to more profitable vehicles. We're going to make in Tennessee now an affordable pickup truck. I think it's going to really surprise the market. These are customers we know. Not a lot of guesswork in terms of the revenue, the cost we need to get at, and a more affordable van in Ohio. So these are going to be better investments for the company profit. And all those hybrid sales, those are really profitable vehicles for us as we basically deploy hybrid across our lineup. But we're also going into the energy storage business to 20 gigawatt hour. That's a big move. We're going to convert our battery plants from automotive batteries to energy storage batteries using LFP. That's also a big pivot that is profit positive for the company.
Jim, with regards to that pivot and the energy storage side of it, do you anticipate any concerns by the White House, by the administration here in the U.S., that you are partnering effectively with the Chinese company in order to do that?
Well, look, it's our plant. It's our people, and we designed it that way. We have a licensing agreement, but we feel like it's better to build these batteries in the United States with American workers, with our own Ford workers, and understand the IP than to import them like they're being done today. The best way to compete with the Chinese is to get close to the IP and then run the plants at Ford. When Ford knows how to build things, we know how to do this. So I think this is much better than for America. We're talking about thousands of incremental jobs versus importing batteries like we say today. Much better for America.
Well, to continue on the energy storage business, you mentioned that this will be profit positive for the company. And when it comes specifically to that new business line, how long would you expect before that alone becomes profitable?
Yeah, great question. Well, we're busy now. We have to move this business moves much faster than the auto business. We're converting our Michigan plant as we speak with all new equipment to make energy storage, which is slightly different than automotive with the LFP. And then we're building a whole new plant, converting Kentucky 1 to 20 gigawatt hours. And that will be landing in late 27. We're going to be selling and servicing batteries, not just the cells as a contract manufacturer. We're actually going to be selling the huge storage containers to utility companies and the AI data center companies in 27. We're already out there quoting this business now. We know what kind of price points we need to get to for it to be profitable. And this is not our first rodeo as a manufacturing company.
It looks like, Jim, that we've gotten new regulations or seen older regulations scrapped, both here and overseas, right, in terms of what's necessary. I'm wondering if the administration here in the U.S. and the EU have helped you and other car makers really serve customer needs better, because we're seeing your rivals also bring back products that were previously canceled, like the Hemi over at Stellantis, that customers wanted.
Well, look, I think, I was at the White House with the president. He announced the revised CAFE standard. Anything we can do to get the regulations to look more like customer demands. Look, we're going to 50% electric. There are no gas guzzlers in our future at Ford, but we want to offer customers choice. And I think that's what the president is trying to do, is just to give people choice. We're going to have this affordable electric vehicle built in Kentucky. I think it's going to be a huge hit with Americans, but it's going to be part of a broader portfolio with choice. And we're seeing the same thing in Europe. We're seeing the same thing around the world. Look, we all want to lower our CO2 footprint as industry. That's what Ford's going to do, going 50% electric. But we need to give customers choice and then use our manufacturing flexibility to go with where the customers are. And that's what this announcement is about, having optionality.
Jim, though, it's not only about powertrains, right? I mean, one of the other things customers want is repairability. And I wonder if, because you already make the F-150 in Kentucky, you make it in Kansas City. My Raptor was born in Dearborn, where I was happy to pick it up years ago. But the new trucks are aluminum bodied. Are you going to be able to build steel trucks, for example, at the Tennessee plant?
Oh, that's a good question. Well, I'm not going to give, because if I tell you, Matt, I'm telling all my competitors. I'm not going to do that today. All I will say is we are coming out with affordable vans and pickups that Americans are going to love. And we're the #1 brand for both those segments. And they are going to love these new products. And they're going to fit into what Americans are buying today. And they're going to be low CO2. And they're going to be more affordable. That's all I can say, Matt. I'm not going to give anything to my competitors.
All right, you don't have to give anything to your competitors, Jim, but I am curious if you can just speak a little bit more to investors. First, about the $19.5 billion charge.
Sure.
But also obviously it's huge, and we talk about this idea as to whether this will be it or whether investors should anticipate potentially more costs associated with the unwind.
Well, look, we're unique from our competitors. We don't have plants that are electric. We have a whole business that's electric. So we looked at that whole business and evaluated the valuation of the assets, and we made these decisions on the future products. The bottom line is the cash subset of that is about $5.5 billion of the $19 billion. And the ROI on that $5.5 billion is very attractive. These are great products. They're affordable. That's where the market is today. And we're going to have great powertrains for them. and they're going to be able to buy more affordable Ford trucks and vans than we have today. And we know there's going to be a profitable business for those out there. So this is a better allocation of capital. That $5.5 billion of cash is going to be a great investment. It didn't make sense to keep plowing billions into products that we knew would not make money. We had to make this choice.
I hear what you're saying there, and certainly the market spoke, but what gives you the confidence that you think about 2029, the goal to have a profitable EV business? You've been losing billions in losses on EVs.
Yes.
What gives you the confidence that you'll be able to turn that around by 2029?
Well, we think to make that business profitable, we have to get to a BYD cost. And so this Skunk Works project called the Universal Electric Vehicle that we're making in Kentucky, that is designed to match the BYD cost in like a Mexico. And we really believe we have that delivered. We've sourced all the parts now. We're testing prototypes. We're starting to run the production line. And so we have real confidence that we can do that. And that's why we're telling people that we think we'll be profitable. We've worked hard for the last couple of years on this EV project, and we have fully competitive costs with the Chinese. Now it's our chance to bring a pickup truck with that low-cost EV to Americans. We think it's going to be a big hit.
Hey, I want to ask about the Chinese because while I love it when companies go back to steel and V8s and stick shifts and handbrakes, obviously many people are betting the future is on EVs, autonomous vehicles, and the Chinese are certainly making real strides there. As you make this pivot back to sort of the classic American pickup truck, what will you do to keep up with the Chinese as they continue to make strides forward?
Make no mistake. Our strategy as a company is to give people choice. Part of that choice is to have fully competitive costs with BYD localized in North America. Matt, we are going to have a fully competitive BYD EV built here in America for Americans that we believe are going to be profitable. And to do that, we had to massively innovate, bring LFP to the United States, reduce the manufacturing content of the vehicle radically, redesign the whole assembly process, engineer the vehicle with all new suppliers. It's a whole different approach on the whole engineering of that vehicle. We are here to compete globally. We're not going to cede our future to the Chinese. And we're the most American car company, but even for us as the most American car company, we're a global company. And that UEV product is the heart and soul of our competitiveness for the future. But the Chinese don't know their truck customers like we do. And we know customers want E-Revs and they want hybrids and they want Raptors like you have. It's a diversity of all that lineup that makes sense for us to compete and win against them.
And that was Ford CEO Jim Farley. Coming up, Hot Picks. We'll look at 3 plays in tech from Jed Ellerbrook, portfolio manager at Argent Capital Management, when we come back. Time now for Hot Picks in Tech. We were joined earlier by Jed Ellerbrook, portfolio manager at Argent Capital Management. We kick things off with what the bull case is for Microsoft when it comes to AI.
Microsoft Azure is the fastest growing cloud computing business in the world. Their big customer, OpenAI, is seeing rapidly rising usage and workloads. Azure benefits from that. Microsoft is also able to hold in their operating margins despite that really strong growth, which is something most cloud computing companies have been unable to do. Oracle is struggling with margins going down a little bit in exchange for that big revenue growth. Microsoft doesn't have to do that trade-off, so that's great. And then finally, Microsoft's software business is also performing well and growing consistently. So I think Microsoft is really firing on all cylinders today. Revenue growth accelerating, margins holding in, continued strong investment in data centers that are generating a clear ROI.
You say that Microsoft is aggressively building out data centers to handle its enormous computing needs, but they're doing it in a prudent way?
They are. Yeah, they are. All these companies, all the cloud computing giants, Microsoft, Amazon, and Google, they all have more demand today than they can satisfy. And more supply comes from opening up these big new AI data centers that are under construction all over the world. And so they are chasing demand, but they're doing it in a prudent, responsible way. They're making sure that they build data centers that will be fungible and usable for a variety of different workloads and tasks. And they're not just building anywhere and everywhere they can get permitting.
Let's get on to your next player, and it wouldn't immediately leap to mind as a tech stock, but it's Apollo Global Management, private equity giant, and they are becoming a major player in data centers.
They are, yeah. Apollo has expanded recently into the financing of data centers. I think that Apollo is a compelling stock because the valuation has come down as the stock underperformed in the first half of 2025, or maybe even first 3 quarters of 2025. It's since started to rebound, which has been nice. But I think the company is seeing really strong demand for their alternative investment products. And they've also got an upcoming fundraising cycle that's going to boost their growth in 2026 and 2027 as well.
Right. I mean, they've teamed up, they're teaming up with our own Brookfield, among others, Apollo Global. How much of is a big part of their asset base now focused on tech?
It's still pretty small today, but it's growing rapidly. 80% of Apollo's business is private credit lending. And the infrastructure group focused on data centers is a small chunk of that, but growing pretty rapidly. And I think that private credit, there's been a lot of fears with regards to that. A couple higher profile bankruptcies, mostly tied to the auto sector, have really soured sentiment on private credit lately. And I think that those fears are overdone and will be disproven over the next couple quarters with just consistent execution from Apollo and Brookfield and other private credit companies.
And then finally, Tyler Technologies. Just remind us what they do and what has caught your eye here.
Yeah, Tyler's a niche business that most people have not heard of. So they provide technology services to cities, municipalities, counties, and states, mostly in the United States. So that is a relatively slow-changing, slow-to-adopt technology, unsophisticated client base. They need help managing the operations of their communities. So that might mean utility billing systems, accounting, courts and justice software systems. And Tyler provides all of these things. They're kind of the best of breed supplier to this particular niche. They have about 50% market share. They've been growing that market share over time, and they're highly profitable, so they can reinvest in adding AI functionality on top of their existing software. And I think that their client base is going to be eager to adopt those AI add-ons over the next few years.
That's interesting. And so when you say an AI add-on, what is that? Just remind us.
Yeah, sure. So it's oftentimes something simple. Instead of filling out a long form online to rent out the gazebo at the local community park, it might be a more like kind of chat interface, like a ChatGPT style interface that's easier to use, self-service, quicker for consumers to use, and results in a slightly happier community. And cities and states all around are going to be adding functionality like that to make things greater self-service, so they can employ fewer people in call centers and help desk positions.
And he was speaking with Jed Allerbrook, portfolio manager at Argent Capital Management. Still ahead, today's market movers with Bloomberg's Matthew Griffin. All right, Know Your Options is back. Tune in tomorrow at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. Send us your questions at knowyouroptions@bnnbloomberg.ca. Okay, let's take a look at some of the movers south of the border. We're joined now by Bloomberg equities reporter Matthew Griffin. Matthew, thanks as always for joining us. We'll start. We're going to kind of run the gamut here. We're going to start with, on the drug side, we're going to go with Pfizer first, and what's happening with it.
Yes, Pfizer is selling off today after the drug maker gave an outlook for revenue next year that disappointed investors. Pretty clear to see what the issue is. That revenue outlook implies that there will be little to no growth. The range there, $59.5 billion to $62.5 billion. Midpoint of that range is below what the company expects to report this year. It's below what analysts expected for next year. And it really underscores the tough patch that Pfizer is in. They really raked it in from their COVID shots and treatments over the last few years, but those sales are down. Other drugs they make are facing competition, and they're kind of in turnaround mode. Their CEO, Albert Bourla, is on a quest to reshape the company, especially through acquisitions. You'll remember they just won a bidding war with Novo Nordisk for Metsera, which is developing obesity drugs. So there is a plan in place here. The idea is that will eventually lead to new successful drugs, to higher sales, but that hasn't paid off yet. Investors are still skeptical. The stock this year lightly in the red, but has really fallen since its COVID highs today, extending that decline down as much as 4.7%. That's the most in one day, 5.7%, most in one day since April 10th during the tariff chaos.
And I'm just looking some of the things they've had delays in some testing. The fulvestrant trial in advanced breast cancer looks like they just had some delays. That just came down today. Bit of a rough ride for them.
Yes, and there could be a long ride ahead before some of their turnaround efforts bear fruit. You look at Metsera, obesity drugs are a hot ticket in the market today, but those drugs are in development. The candidates at that company will need to go through more testing. This is probably why Pfizer plans to start 15 obesity drug trials next year. Most of those will be late stage and involve Metsera's candidates. So we could eventually see some payoff, but again, there still is a bit of a road here. They can't just bring drugs right to market and start selling them after some of these acquisitions.
Okay, defense stocks also tumbling with the possibility, I think everybody else probably welcoming this, that U.S. could offer Ukraine security. A security guarantee, yes. I should say.
Yes, so U.S. defense stocks are weaker today on, again, yes, what most onlookers would consider positive news out of peace negotiations that have happened in Berlin over the last couple days. The latest headlines, the U.S. is moving to offer those security guarantees. One U.S. official compared them to Article 5, which is the NATO Mutual Defense Pact, said they would be Article 5-like. Ukrainian President Volodymyr Zelensky has said he's reached a deal with the U.S. to make those guarantees legally binding through a vote in Congress. So this is all seen as progress in Donald Trump's push to bring the war to an end. Of course, nothing finalized. We still have to hear from Russia, for example. But that's already reading through today. Two U.S. defense stocks. One I would call out is RTX. They've been a high flyer this year, parent company of Raytheon, which makes missiles, other defense munitions, down about 1% today. If you think about why the prospect of Russian aggression during the war in Ukraine has pushed European countries to step up their defense spending, especially this year. And what one of my colleagues at Bloomberg Intelligence tells me is take away the war and countries may start to tap the brakes a little. You could even see lower spending in the U.S. Companies like RTX, of course, benefit from U.S. spending. They're also expected to benefit from higher European spending. So again, take away some of those tailwinds, you get a sell-off here, but there's still strong demand in commercial aerospace. Analysts see the defense sector continuing to grow, so that's how you have the stock still up about 50% this year.
Okay, we're going to have to end it there, but Matthew, thank you as always.
Thanks for having me, Roger.
Bloomberg's Matthew Griffin. Well, that wraps up this edition of Trading Day. I'm Roger Peterson. Thank you very much for joining us. Have a great day.